Okay, so for today's video, I'm going to be covering external range liquidity versus internal range liquidity. Now, hopping straight into this is a concept that I use a lot of the time, most days. It's a very algorithmic, basic structure that tends to form a lot of the time in the markets. I personally use this for the lower time frames. However, you can use this on the higher time frames as well. It can give you a good judgment of where the draw on liquidity might be for the day. So hopping straight into this, what we're going to have is our range. Okay, so this right here is our range. So we have a range high and a range low. So what is going to be on the outside of these ranges is going to be your liquidity. Now, it being on the outside of the range makes it external range. Okay, so now we have our external range liquidity, which is very easy to understand. It's just lows and highs on the outside of the market. What is going to be our internal range liquidity is going to be our fair value gaps. So here we have a fair value gap. So this is going to be our internal range liquidity. So now after making a swing high and a swing low, I would like to see price head lower, fill this inefficiency here, and then take out the external range liquidity. So this is exactly how the model works. We've taken out internal, so the highest probability is for us to now take out external. So now this is going to be our next range low and our next range high. So these are going to be our external and external draws. Now what happens when price comes lower to take out this external draw? We then move higher to take out this internal draw, and then we can catch the continuation lower to take out the next external draw. So this is the basic understanding of how external range liquidity to internal range liquidity works. Once we take out an external range, we can then anticipate a run on internal range liquidity. Vice versa, once we take out internal range, then we can expect a run on external range. Okay, so right here on NQ, on the hourly time frame, we have our external range liquidity right here. This is our swing low, this is our swing high. Now the swing high didn't get met on this day. However, once taking out the external drawdown here, we had a move higher in price to take out the internal range, which is going to be this fair value gap right here. Now what happens once we take out this external range, we come back with this internal range, we come back lower to take out the next external draw on liquidity, which is this right here. Okay, so now we're on the 4-hour time frame, just to show this working on a different time frame. As you can see, we have our swing high here and our swing low here. These are the external draws on liquidity. What happens when this external low down here gets taken? We move back higher in price to take out this internal draw. So now, what can we expect for the next day? We can expect a move lower or a move higher to take out the external draws, which would be this low or this swing high right here. So now for the next day, I have a good understanding of where the market is most likely to head. Now just pairing this up, this is a bearish fair value gap, so the highest probability of either external draws getting hit is the lower portion, as we are already reacting out of this. So once we come take this out, I would like this fair value gap to get left right here, and then the structure I would be looking for is the run lower to take out the external draw, and then the run back inside to take out the internal draw. Okay, so right here on the weekly chart on NQ, as you can see, this external range liquidity got taken out by this candle here, and then we had our move lower to take out all this internal range liquidity. This is the next external draw right here. As you can see, it's a prominent low inside of a fair value gap, so this is going to be the range low and the range high. So once this range low gets taken out, the external draw, price has a move back inside the range to fill this imbalance right here. Now, after seeing us take out internal range, you can be expecting a run on external range, which is exactly what we get right here. As you can see, price took out this external range liquidity, and then we've had a run back up inside to hunt internal range. Now, this fair value gap was fully mitigated with this wick here, so the next valid internal range liquidity to target was this fair value gap right here. So now what we can be expecting is a run on external range liquidity, meaning either inversing this fair value gap and hunting this high up here, or respecting this fair value gap and coming for this swing low down here. So that is how you can use it on the weekly time frame to have a weekly outlook on where the draw on liquidity may be. I personally used this after seeing how price took out this internal range right here. I was looking for external range, which was this low down here, However, we came even lower to take out this low. As you can see, as soon as we've taken out this external range, we've had a volatile move back up higher to take out internal range. So this is essentially how the market is moving. So we're having our swing lows, swing highs, hunt on hunt on our internal range liquidity, back out to external, coming lower, taking out external, hunt on internal. Now this is how you trade it in trends. So we're having our move higher, internal range, external range, internal, external, internal, external. Now this concept doesn't work 100% of the time. As you can see, there's been many instances where we have just taken out an external draw and continued higher. So this is another one of those concepts that you need to backtest for yourself and find how you can implement this into your own day trading, your own models. So now we're looking at Bitcoin on the weekly time frame. Look exactly what's happened here. External draw and liquidity, price has taken out this external draw, we've had a move back lower to take out this internal range. So now we've taken out this internal range liquidity, it has given price momentum to come back higher to take out this external range. Now we've had a close on this weekly high up here, where we're about to close in a day. So if we close sweeping this, then we can expect a hunt back on this internal range right here, for then a potential expansion back higher to take out the next external draw, which will be this high right here. Okay, so right here I have another perfect demonstration. As you can see, we have these highs right here. We have our manipulation higher to take out these highs, and then price comes back down into what? Into our internal range liquidity, which will be this fair value gap down here. Could have also been this one as well. As you can see, we've respected this one and then had our move higher. However, for this we have seeked down lower to take out this internal draw, and then we've had a run back higher to take out these external highs up here. As you can see, we've just distributed straight above them and continued the trend higher. Okay, so now I have another range right here. As you can see, the most prominent low, this low down here. What happens once price takes out this low? We get our move back higher, hunting these fair value gaps. Now we've pushed through these fair value gaps and hunted this high up here. Now what happens once we take out this high? We get our hunt on internal range. So once taking out this internal range, the next highest probability of the move is going to be another external draw. Now what happens again? We have our move higher, and then we have our hunt on internal range liquidity again, and then we catch the continuation higher. What happens once we take out our internal range? We have a hunt on external range. Now here is a perfect demonstration on a forex pair. We have this external draw right here, and this was the swing low of the other external draw. As you can see, swing high, swing low. What happens when our swing low gets taken out? We have our hunt on internal range liquidity, this fair value gap right here and this fair value gap right here. Now what happens once we displace through these fair value gaps? The next highest probability for the market to go is this external draw up here. What happens once we take out this external draw? We want to keep the trend bullish, so we come and seek this fair value gap right here, and then we have our run higher. So now we've taken out a lot of external range liquidity right here. We've had a major sweep here. So now for next week, as you can see, prices come lower, tapped into this fair value gap, held it perfectly, and then we're getting our distribution higher. So where could our next targets be? Either this low or this high of the range, both external range. Judging by how this fair value gap got respected, I'm putting my bets on this being the next high to get hit. And that's how you can get a weekly outlook on your forex. Okay, so for the last portion of the video, I'm just going to be going over the terms and abbreviations correlated to today's video. Now there weren't many today, and the ones that I did use I've already gone over in previous videos, so if you're following this playlist then you should understand them. But for now, we've got ERL, which stands for external range liquidity, and we've got IRL, which stands for internal range liquidity. So you can screenshot this one more time. You can screenshot this now if you want. These lows, this low and this high, external range is on the outside of the range. Internal range is inside of the swing high and the swing low. It's going to be your fair value gaps. Okay, so that is going to be everything for today's video. I have recently built up a free live trading Discord where I trade every single day, giving out my daily bias. So feel free to join that. The link will be in the description below. But yeah, so that's going to be all for today's video.